Before I start, I just want to say this clearly. Everything I'm about to share is simply how I think about markets. It's not investment advice, it's not a recommendation, and it's definitely not telling anyone to chase a move or try to call a bottom. It's just one investor's framework. Now, if you've been paying attention to China's equity markets recently, it's actually pretty hard to ignore that something has changed, and I don't mean that in a hot trade kind of way. I'm not saying there's a crazy speculative bubble forming or that this is some short-term momentum story. What I am saying, as someone who has spent most of his investing life focused on US markets, is that China has quietly moved back into a space where it feels worth discussing again. And that alone is already a shift. For years, China assets were easy to dismiss. The narrative was negative, capital was flowing out, valuations kept compressing, and frankly, a lot of global investors just stopped paying attention. But markets don't work in straight lines forever, so let me explain how I personally look at this, starting with A-shares and Hong Kong. Over the past few years, Chinese equities went through what I'd call a very classic compression cycle. Valuations got squeezed, stories lost credibility, foreign allocation ratios dropped steadily. It wasn't comfortable, and it wasn't quick. But cycles like that usually leave behind one important thing: a much lower starting point. When you go back and look at data, research, and reporting around 2025 and beyond, there's a pretty consistent pattern showing up. Policy support became more explicit, not just in words, but in direction. And at the same time, the market's focus shifted away from pure concepts and slogans back toward the industrial side of the economy. Things like industrial upgrades, clean and renewable energy, domestic AI chips, advanced manufacturing capacity. These aren't overnight themes. They're the result of years of capital expenditure, engineering iteration, and supply chain scaling. That's very different from the old growth at any cost internet cycle. Now, Hong Kong plays a really interesting role in all of this. Structurally, it sits right at the intersection. It's connected to global capital flows, but it also reflects expectations around China's tech and manufacturing earnings more directly. And because of how that structure works, when sentiment starts to improve, Hong Kong tech stocks often react earlier than A-shares. That's not speculation, that's market mechanics. You see it again and again across cycles. Now, let me contrast that with the market I know best, the US. A Fed rate cut, by itself, doesn't guarantee that risk assets keep going higher. Anyone who's traded long enough knows that. But what it does do is change the backdrop. It forces capital to reevaluate relative value. And right now, US tech, especially the large AI names, is in a very interesting position. These are high-quality businesses. That part isn't in question. But if we're being honest, they're also extremely crowded. Valuations are full, positioning is concentrated, expectations are high, and when you layer all of that together, it becomes harder to argue that future returns will be driven purely by multiple expansion. So if you're someone who thinks in terms of risk management, not just upside potential, it's pretty natural to start asking a different question. Is there a part of the global market that's less crowded, more conservatively priced, and structurally positioned to benefit if liquidity conditions improve? That's where the idea of allocating to China starts to make sense. Not as an emotional shift, not as a bold prediction, but as part of a global rebalancing process. Now, the next question is always practical. How do you actually express that view? My personal habit has always been the same. I start with ETFs. When your thesis is macro or structural, using a single stock often magnifies company-specific risks, regulation, execution, competition, timing, and that can easily distort the original idea. If you look at China-related ETFs today, their roles are actually pretty distinct. If you're focused on internet platforms and sentiment-driven moves, something like KWEB or CNQQ behaves like a high beta thermometer. They react fast, but they also swing hard. If, on the other hand, you're more interested in industrial upgrading, hard tech, and long-cycle engineering capability, you need a broader and more balanced lens, and that's where CNQQ naturally enters the conversation. I want to be very precise here. I don't treat CNQQ as an answer. I don't treat it as a call. I treat it as a lens. It's a NASDAQ-listed ETF, which already makes it operationally easy for US-based investors. But more importantly, its coverage goes beyond consumer internet. It includes semiconductors, AI applications, cloud infrastructure, clean energy, intelligent manufacturing. So instead of watching one company win or lose, you're watching how China's next generation of technology responds to changes in macro conditions. For me, its value really comes down to three things. First, it's tech-oriented, not dominated by financials or old cycle sectors. Second, it trades in the US with familiar liquidity and market mechanics. Third, it's broad enough to support structural observation rather than emotional chasing. That distinction matters a lot to me because the goal isn't to predict the next breakout. The goal is to stay oriented. So if you ask me where I stand right now, I'd summarize it like this. I'm not rushing in just because China is rebounding, and I'm not ignoring it just because US tech still looks strong. What I'm doing instead is leaving space in a global allocation, using ETFs, to observe and participate gradually, without turning it into a high-conviction emotional trade. From the perspective of someone who's traded US markets for many years, having that extra window open actually makes a portfolio feel more flexible and more resilient over time. And honestly, that matters more to me than trying to be exactly right at exactly the right moment.